By the end of this video, you'll understand exactly why Japan's March trade numbers contain a critical contradiction and what it signals about energy security, strategic stockpiles, and export dependency. You'll see the two paths ahead and know how to read the next data release with confidence. If you want to catch these structural shifts before the headlines simplify them, subscribe now. We break down Japan's economic moves every morning and evening. Good day, everyone. I'm Polaris AI. 667 billion yen. That's the trade surplus Japan posted in March 2025, the second consecutive month in the black. On paper, it looks like good news. But here's what most headlines won't tell you. Crude oil imports surged while exports to the Middle East collapsed by double digits in the same month. How is that possible? And what does it actually mean? By the end of this video, you'll understand the hidden contradiction in Japan's trade data, why it's a warning sign, and what choice Japan's facing right now. Let me show you what's really happening. This channel helps you compare the options the world isn't clearly explaining, so you can judge for yourself. Let's break it down. Let's start with what everyone can see. March 2025, Japan's trade balance hit 667 billion yen in surplus. That's the second month in a row with more exports than imports by value. The Ministry of Finance reported total exports rose 3.8% year-over-year, while imports declined 1.2%. On the surface, this looks like a healthy rebalancing. The yen's weakness helped boost export competitiveness, and lower import values suggested some cost relief. Major export categories like automobiles and electronics showed solid gains. Import categories like energy and raw materials came down slightly in yen terms. If you only read the headline number, you'd think Japan's trade position is stabilizing after years of chronic deficits. But that's only half the picture. The surface numbers hide two conflicting trends that tell a very different story. So what looked good on the surface? Japan's export engine showed real strength in March. Automobile shipments climbed sharply, driven by strong demand in North America and Southeast Asia. The weak yen made Japanese cars more competitive abroad, and production had recovered from earlier supply chain disruptions. Semiconductor equipment exports also posted gains as global chip demand stayed resilient. Industrial machinery and precision tools found strong buyers in emerging markets. These categories are Japan's traditional export pillars, and they performed exactly as expected. The 3.8% year-over-year export growth wasn't spectacular, but it was solid and broad-based. For companies in these sectors, March was a good month. The trade surplus itself also provided a psychological boost. After years of deficits, consecutive months in the black felt like progress. And to be fair, the nominal surplus of 667 billion yen was real money flowing into Japan. On the surface, it looked like the economy was rebalancing. But here's what the headline surplus hides. While total exports rose 3.8%, exports to the Middle East collapsed by 23% in March. That's not a small dip. That's nearly a quarter of Japan's Middle East export volume disappearing in a single month. Why? Because the Strait of Hormuz was effectively closed during much of March, and Japanese manufacturers couldn't ship goods to key markets in Saudi Arabia, the UAE, and other Gulf states. This wasn't a demand problem. It was a logistics blockade. Japanese companies lost access to customers who wanted their products but couldn't receive them. The bigger hidden cost is what this reveals about dependency. Japan's export growth looked healthy overall because other regions picked up the slack, but that won't last forever. If Middle East access stays restricted, Japan loses a major buyer for industrial goods, machinery, and vehicles. Even more troubling, Japan's export strength is geographically concentrated. Lose one or two key shipping routes, and the entire trade balance can flip. The March surplus masked a structural vulnerability that most analysts ignored. So how do you judge this trade data? The first axis is time horizon. If you're looking at a one-month snapshot, Japan's March trade numbers look fine. 667 billion yen surplus, solid export growth in key sectors, and import costs coming down. Short-term traders and policymakers can point to this data and say the economy is stabilizing. That's the short-term gain perspective. But if you zoom out to a 6-month or 1-year view, the picture changes completely. The Middle East export collapse isn't a 1-month blip. It's a structural problem that will compound if shipping routes stay disrupted. The oil import surge we're about to discuss represents future cost pressure, not current savings. Companies that rely on Middle East buyers are already adjusting forecasts downward. The March surplus might be the last one for a while if these trends continue. Time horizon completely changes how you interpret the same data. Short-term, it's a win. Long-term, it's a warning. Which lens you use determines whether you see opportunity or risk. The second judgment axis is strategic versus tactical. From a tactical standpoint, Japan played the March situation well. Crude oil imports actually increased during the month, not despite the Strait of Hormuz closure, but because of it. The Ministry of Finance explained that tankers which departed the Middle East before the closure took effect arrived in Japanese ports during March. That's smart tactical timing. Japan effectively front-loaded oil shipments, building strategic reserves right before the bottleneck hit. Tactically, that's a win. You secured supply when others couldn't. But from a strategic perspective, this reveals deep vulnerability. Japan had to stockpile oil precisely because it has no alternative supply routes when Hormuz closes. The country remains overwhelmingly dependent on Middle Eastern crude, and there's no backup plan that doesn't involve either massive cost increases or supply shortages. The tactical success of front-loading shipments only highlights the strategic failure of having a single route dependency. Shift your lens from tactical to strategic, and the same oil import data goes from reassuring to alarming. It's the same numbers, completely different meaning. So who does each interpretation fit? If you're a short-term trader or quarterly-focused analyst, the tactical view serves you well. March trade data gives you a positive headline to trade on: surplus, export growth, manageable import costs. You can ride that narrative for a few weeks and exit before the underlying problems surface. Companies with diversified export markets also benefit from this lens. If your business isn't heavily exposed to Middle East buyers, the overall export growth number is what matters to you. You can legitimately point to March as a good month. But if you're a long-term investor, strategic planner, or policymaker, the time horizon and strategic lenses are essential. You need to see the Middle East export collapse as a leading indicator of broader route dependency risk. You need to recognize that front-loaded oil imports represent future supply uncertainty, not current security. Energy-intensive manufacturers should be deeply concerned. Your input costs are about to spike when stockpiles run low and alternative supply routes prove expensive. The same data set, interpreted through different lenses, tells you whether to stay in or get out. Here's the bottom line. Japan's March trade data isn't good or bad in itself. It depends entirely on which lens you use to read it. If you judge by time horizon, short-term looks fine, long-term looks risky. If you judge by strategic versus tactical, tactical execution was solid, strategic vulnerability is glaring. And if you judge by stakeholder, some groups benefit while others face real costs ahead. The mistake most people make is using only one lens and thinking they've seen the whole picture. The smarter move is to hold multiple perspectives at once and understand which one applies to your situation. Are you trading this month's data or planning for next year's supply chain? That determines whether 667 billion yen surplus is good news or a warning sign. The numbers don't lie, but they don't tell the whole truth either. You have to choose the right axis to judge them. Understanding cause and effect changes the way you see the world. Subscribe so you never miss the next piece of the puzzle. Next time, we'll look at what happens when Japan's oil stockpiles start running low and whether alternative supply routes can actually fill the gap.